Well, all right. Well, let's go ahead and kick off. Thank you guys for joining us for our webinar today. The topic is revenue-based financing and the tax implications of it. We have with us today Buck Hollister, who is going to lead us through the presentation and talk about the different topics. And you'll see quite a bit of information in this presentation. We will record it, and we will send that to you after the presentation is over, along with a PDF of the slides, as there's a great deal of detail on these slides. And then, of course, Buck's contact details are on the last slide, and you're welcome to pick up his contact details and follow up with him if you have any specific questions afterwards. So again, thank you for your time, and with that, I'll go ahead and pass it over to Buck, and we'll kick off from there. Buck will talk for about 30 minutes, and at the end we'll take your questions. There's a questions box in the lower right-hand corner of your screen. You're welcome to type in those questions as they come to you, and then when we get to the end, we'll open that up. We'll read those questions, and we'll answer as many as we can in the hour that we have. So with that, Buck, are you ready?
I'm ready.
All right,
well,
go ahead.
Good afternoon, ladies and gentlemen. Thank you. Good afternoon, ladies and gentlemen. I appreciate you giving me the opportunity to be able to speak here today. Tax implications when you're starting to look at whether you want to do a revenue-based financing deal. And as you'll soon see, there can be some significant implications at that. Going through and looking at it kind of at a high, it's good to kind of have background information as far as for when you're approaching these type of deals, as far as for type of revenue-based financing deal structure would be optimal for entrepreneurs. On the other hand, what's also going to be optimal for investors, and is there a way to go and be creative and set up the RBF deal so it should be advantageous to both entrepreneurs and investors. You're also going through, and you can't that initial threshold issue. The next layer down that you kind of want to drill through is to kind of look at, well, are there any special considerations you should take into account when structuring like payout? Going to do an RBF equity deal. Particularly, are you going to structure the payout as a qualified dividend, stock redemption? And then at the same time, down one additional layer as far as for this presentation purpose, you also kind of want to take a look at timing, because there's different advantages for basically holding back on the payments and maybe possibly delaying, keeping the money in a trust account up until a certain point, and then distributing the funds to the investor. And even though there might not be specific tax advantage for the company if you structure a transaction a certain way, if you're significant tax advantages for the investors, easier way to be able to go and attract investment funding as well. Before we go any further, I think it's important so that, before you can look at the tax issues, to be able to understand the three general buckets as far as like revenue-based financing deal. In the one bucket, there's like the debt bucket where pure debt financing. The second bucket would just be like a pure equity financing. Typically that's done through like a Series A or some other type of preferred stock offering. And then the third bucket is like a combination of like debt and equity. And some nuances as far as for the debt side is that typically the way it works, investors will loan like a certain sum of money. It could be like up to $1 million or more, and then they'll expect like applicable interest rate back. And if the certain requirements are met, then they'll start sharing into the revenues as well. And it can be anywhere 3 to 7% of company revenues, higher or lower. It just depends on what you negotiate out between the parties. And then there's like a repayment time frame that's set up where the loan principal and the interest return requirements are satisfied. And then once that's done, the deal is complete. And kind of some caveats here for the state of Texas, and each state is different. Texas does usury laws or lending laws as far as in place, and so if you're going the debt route, it's good to actually go and be aware of like any usury law caps. Typically, if you're lending, the most you can actually lend and charge as an interest rate is 18%, and you can typically go to the state government's website. I included a link there where you can actually see what the latest rate is. They'll change at various points because they're based on statutory formula and the Texas Finance Code. And the interesting piece is this, is that if you're going out and you're needing funding, and let's say you're at the $200,000 level and you think that's all you need, you may still want to bump up the principal amount to above $250,000. Because here in the state of Texas, you can actually go and fall under what's known as a qualified commercial loan, and then basically be able to enable the investors to share into the revenue stream, and then the interest rate caps are not applicable for that revenue sharing portion of it. And so that's something for when you're structuring the deal. Equity side, typically what happens, Investors will invest like an equity tranche. It's typical like a private placement deal. It's like a Series A or Series B preferred stock offering, whatever series at. They'll invest and they'll stipulate that their initial investment amount and a certain amount of return back. Typically, it's like 3x or 5x. If you pay back in 3 years, it's 3x, 5 years, 5x, or whatever you're able to negotiate at that point in time. And basically is that if you're doing the equity side, there's kind of some caveat in mind when you're going through and structuring it, because you got payouts and then kind of incorporate into the tax that making sure that if you're going to pay out and do an RBF equity deal is that you either structure the deal as a one company or a two company. And the reason why I'm emphasizing one company is that if it's a Texas corporation, and typically states, including Delaware as well, there's a term known as surplus. Basically, a company can't pay out more than its surplus, which is really the net assets of the company. And if a lot of these companies that are growing and emerging don't have sufficient surplus, then a lot of times what you can do is structure a wholly owned subsidiary, transfer the IP to the subsidiary, or work out some other intercompany agreement, but then the investors would invest in that subsidiary and then control the cost, so then you can get the money out in the equity side that way. And the goal for the investors on the equity side, from a tax standpoint, is to really kind of structure the payouts either as qualified dividends or and because they have preferential tax rates. Bucket is really kind of a combination of the previous. You have debt and equity. One way you can structure it is that basically you could go in for a loan and then you could have a certain portion of the return actually be interest, or basically like 8 or 10%. You'd want that for IRS purposes and be very clear what piece is the interest and then what piece you would actually want to convert over to equity, because then there could be another component for the sharing of the revenue that you basically have a warrant, and then you're able to go and exercise that warrant and get some type of equity instrument, like, for example, a Series A preferred stock, and then through there, then the investors can actually go and get their preferential tax treatment. The beauty of actually structuring it from like a debt and equity perspective is that there's actually benefits to both the entrepreneur and the investor itself from a tax standpoint. And then it also goes and enables the investors, if they have concerns about the being too risky, they can also get a security agreement. You have a better ability to attract funding to your company. As far as for the RBF debt deal tax, the tax impact to the investor is that, you know, the income that they recognize, individual income tax rates, because it's interest income. They could structure it in the deal documentation where they can stipulate payments may be principal, so they can control the timing of when they'd recognize the interest. Like that, you'd have to work through the details and stuff like that with your legal counsel and with the company and kind of make sure everyone's in agreement and what the protocols are going to be. And at the same time, a debt deal still may be attractive to an investor from a tax standpoint, because if they have other passive losses, they may not care about the higher income tax rate because they can actually offset it and it's a zero tax impact. And so that's something to look at too. The tax impact to the company, though, on the debt side is that basically they can actually go and deduct the interest. And a good way to actually kind of go and look at it when you're in the middle of negotiations is kind of like calculate a back-of-the-envelope calculation. If you know that your interest cost, for example, is going to be $1 million per year, and you know that your effective tax rate for the company is probably going to be in the 30% tax bracket, then really your tax shield or your tax savings would be that 30% rate times the $1 million of interest, or you'd save $300,000 in taxes. And so over time, that can start to add up, and that's a value to the investors. And if you're able to go and have that tax shield, you can add that to the valuation of your company and get a higher value as well. On the RBF equity deal tax impact side, the tax impact to the company is that it really doesn't receive any tax benefits as far as for it, because when it issues qualified dividends or stock redemptions, it can't take it as a deduction on its tax return. Where the benefits come are basically to the investor side. And for the investor, there's really kind of three different buckets when you're looking at dividend payments and stock redemptions. You have the ordinary dividends, qualified dividends, and stock redemptions. The investor really wants to focus on being able to go and fall under the qualified dividend bucket. And then for stock redemptions, they want to face it so that basically and structure it so that if there's a timing issue that they don't go and have their stock redeemed before 1 year from the closing date. And you'll see the tax impact of why that happens in example number 2 for this presentation. And I'm sure at this point some people may be wondering, well, what's the difference between an ordinary dividend and a qualified dividend? Qualified dividend really is basically taxed at the lower long-term capital gains rate versus an individual's ordinary income. And really there's kind of like three criteria they have to actually go and meet for a qualified dividend. First, the dividend needs to be paid after December 31st, 2002. That pretty much can be met by anybody. Second is it needs to actually be paid by a U.S. corporation. And then, I mean, there's other exceptions to it, but that's generally speaking. And then third is that there are certain holding period requirements that need to be met. The best way to think about it is that you should always calculate that a minimum of 61 days from the closing date should be used before the board of directors, if you're doing an RBF equity deal, would actually declare a dividend. I always like to play it safe with my clients. I discuss a days or later, just so that there's no room for arguments or discrepancy, or somebody makes a mistake and then the IRS can pounce on you and say, gotcha. It's the last thing you want to have happen. And then I know it might be a good idea to show like a snapshot so you can kind of see the impact between the difference between an ordinary dividend rate and a qualified dividend rate. And really here, this whole presentation, this piece, it's beneficial because you can see from a longitudinal analysis what happens over time from the U.S. tax structure, and then also do a cross-sectional analysis and look at here in 2013. There's basically about nearly 20% difference, or 2,000 basis point difference, if you have like an ordinary dividend versus a qualified dividend, and so that difference can really start to add up quickly. And then you also have to take into account the Obamacare 3.8% surtax on individuals if they're single, earning more than $200,000 a year, or couples with more than $250,000 earnings. The best way to kind of go this dividend difference would be an example, and that is that if John Doe investor was to invest like $1 million in company ABC on June 15th, and then in exchange he got 100,000 Series A preferred shares, and then the terms were that he would actually start receiving monthly dividend payments. Well, that sounds great. The only thing is that from a tax standpoint, that's not so great, because basically if you go through and company ABC board declares the dividend on July 5th, or less than 30 days, then basically he gets his dividend by July 16th, and the money's there, but the only thing is he's going to have about a 43.4K tax bill. And that's assuming he's in the tax and income tax bracket. For example, 39.6% plus the Obama 3.8% surtax. Now, on the other hand, if you structured it in RBF deal documents where you stated that the first dividend declaration by the board of directors would be no earlier than 70 days after the closing date, then basically you could take advantage of the preferential qualified dividend rates and only have a tax bill of 23.8K and basically have tax savings of nearly $20,000. And so that's something to kind of take into account when you're kind of drafting the terms and kind of be aware of. The other way you can get money out through an RBF equity deal would actually be through stock redemptions. And really what stock redemptions are is you're just going through and purchasing either a portion of the investor's shareholdings through a payment, or else actually going through and purchasing all of their shares and so forth. This depends on how you want to do it and how you want to structure the transaction. And unlike a dividend, you're actually reducing their share of future earnings because you're reducing their shareholding percentage of the company itself. And then if you look at it for basically redemption, again, you kind of want to look at timing, because if you have a short-term capital gains rate, it's going to be subject to the 39.6% tax rate, whereas if you basically wait for at least 12 months, then you can get the preferential 20% long-term capital gains rate. It would still be subject to the Obamacare 3.8% surtax on individuals if they have certain earnings and so forth. And then when you're going through and redeeming like stock for the RBF equity deals, it's very important for the investors in the company to kind of work together and roll up their shirt sleeves and basically make sure that they're going to satisfy one of the safe harbor requirements under Section 302. And there's really kind of like three express ones. There's another one after this that I'll go into more detail about. But really, it's like if you can structure it so that the transaction is like a substantially disproportionate redemption or a complete termination of the shareholders' interest or a partial liquidation, then you fall into those express safe harbors and you can expressly state that, hey, this is a stock redemption versus a qualified dividend. You might be saying and asking, well, it might not be that important now. That's true, because basically the qualified dividends and the long-term capital gains rate for stock redemptions are the same. But as all of us know, tax rates can change, and so you'd want to make sure that your revenue-based financing equity deal documents are flexible enough so that if the tax rates change, you can quickly switch over to stock redemptions and then be able to structure the transaction so that ultimately can fall under a safe harbor under Section 302. If you look at it, first thing to look at is for what is a substantially disproportionate type of distribution, there's really kind of like three different factors you need to satisfy. First is that the shareholder needs to own less than 50% of the combined voting power of all the corporate stock before the transaction. Second, you need to actually go and make sure that the shareholder's interest in the voting stock is actually reduced by more than 20%. And then basically you must also reduce the shareholder's interest in the common stock by 20%. Well, if you're doing Series A stock, you probably wouldn't go and be able to go and fit into that qualification unless it's like convertible Series A stock. And so that's something you got to look at when you're drafting your transaction documents. It has some limited applications, and it's still something to be aware of as you're going through and figuring it out, but it's not the best category. Category actually is a partial liquidation. For example, if the company you thought was going to do well starts to contract and you meet the Internal Revenue Code's basically definition as far as for partial liquidation of the corporation, where basically in essence it's a qualified trader business and you start ceasing it, but then you're able to continue another business, but you're able to show that it's contracting by a certain percentage, then if you're redeeming stock, you can fall under that bucket as well. And there's certain strict requirements that have to be met. Under this category, you can't have like a corporation that's going to actually be a shareholder because it's not allowed. It's expressly stated in Section 302B4A. And then if you look at it, you might be standing here and thinking at this point in time, well, wait a second. It seems it's kind of hard to be able to try to go and get out a stock redemption and be able to fall into safe harbors. That's where we come to the kind of final safe harbor, which I always liken it as, and that's the dividend equivalency standard. That's a good one to actually go and rely on, and that's the one I would say that you would want to focus on for most of your deals. You can always have the other ones, but you can use them as backups. But really what it comes down to is that you try to go and structure the transaction so that it's not essentially equivalent to dividend. You might be going and asking yourself, well, what does that mean? It's almost like basically kind of a roundabout question. It just doesn't answer itself. The Internal Revenue Service tried to go and interpret it and help out people by issuing various revenue rulings. One of them was Revenue Ruling 75-502. And they stated that, if the redemption affects the shareholder's ability to control the corporation, the future interest and the earnings, and then the rights upon liquidation of the corporation, then it would qualify as a stock redemption. From my standpoint, looking at it even from a legal standpoint, CPA standpoint, I still would kind of look at it and say, hey, there's different interpretations. Is there some other more concrete objective or criteria you can actually go and use? And that's where I pretty much came up with like a rule of thumb or cases and revenue rulings that I use when I'm talking to my clients. And that is that first, there was a landmark case stated United States versus Davis back in 1970 where they talked about if stock redemption resulted in a meaningful reduction of the shareholders' proportionate interest in the corporation, then it could actually go and qualify as a stock redemption. Then what I also do is I also look at Revenue Ruling 76-385. That's good because they actually have expressed percentages here where they stated that the shareholders' interest in the corporation was reduced by less than, 1/1000th of a percent, and they basically were still able to go and have that constitute a stock redemption. So that's good. You would want to basically at least have at least 1% of your stock holdings being redeemed. If you're able to, it's also good too if you're going through a stock redemption and you're worried about the tax rates and they start to change and stuff, you can also go and rely on Revenue Ruling 76-364 where in essence if you have about a 6% reduction in your shareholding earnings, that's also good too as well because then you can show that that's a stock redemption. And then the other key piece that you look at is the congressional intent. So if somebody was actually going to challenge this transaction as a stock redemption, you could also point out if you have preferred stock, you're meeting the congressional intent that was basically why Code Section 302B1 or the not essential equivalent to dividend standard was codified in the first place. And a good way to actually go and look at the impact for a stock redemption is basically right now is the timing. Let's again use John Doe individual investor. Let's assume he's in a top income tax bracket, and he goes and provides an assignment advance or an investment amount of $1 million to company ABC on June 15th in exchange for receiving like 100,000 Series A preferred stock. Well, then basically John Doe will then have 10% of his stock holdings redeemed on December 15th, 2013, as it's stipulated in the RBF deal docs. Well, the problem with that is that it's less than a year, and so then he'd be subject to the short-term capital gains tax liability rates, which again is about like nearly 44%, and his tax bill on a $300,000 payout would be $130.2K. Now, if the RBF deal term stipulated that a minimum of 12 months would need to pass before any stock redemption payments, then basically John Doe could actually go through and have a long-term capital gains rate of only 71.4K, and then basically have tax savings of about nearly 59K. And again, this is kind of a simplified example because if there's other portfolio holdings that John Doe has, he may be okay with going with a short-term capital gains because he can offset it with short-term losses and so forth. And so it's just something you'd have to sit down with and kind of work out financially with your accountant or your attorney who's ever actually advising you on the transaction. And then when you're going through and looking at these different type of deals as well, there's kind of like a final kind of general category issue that I always say at a high level you want to look at. There's always a lot of other tax issues you got to explore, but they're kind of beyond the scope of this presentation, is that basically Code Section 1202. Basically, if you have the company that could qualify as small business stock and, you know, it meets certain holding period requirements and so forth, you may want to delay the payments on coming out on your RBF deal for basically a certain number of years. It can still, the payments that are coming, the revenue sharing percentage can still go into the trust account. You just wouldn't have access to it until after 5 years. And the reason why you might want to wait is there is additional tax advantages from doing that, and if the company doesn't enter into any other RBF deals, you can actually reduce your tax liability by an additional 50%. There's additional like specific investor holding requirements you got to satisfy, and it can be very strict. And specifically, you really kind of want to look at Code Section 1202 C3 A through C and just kind of make sure you're not going to run afoul of it, because if you are, then it doesn't make sense to actually go and wait the 5 years. But it's just something to kind of always be cognizant of and so forth. And that really kind of goes and runs through like a lot of the different high-level answers you kind of want to look at when you're deciding like how you want to structure these type of deals. And so in summary, if you look at it, for an RBF debt deal structure, that's the one that's most optimal for entrepreneurs from a deductibility standpoint, because they can deduct the interest. As far as for the RBF deal structure that's optimal for investors, it would actually go and be the equity deal side, because again, they can go and get the preferential capital gains rates, which saves them about like nearly 2,000 basis points. And then as far as for ways to structure the deals, there's a lot of different ways. Just one of the combination ways you could do is you could do a combination of debt and equity and kind of work through the different terms with the investors and with the company so that both sides are getting advantages and benefits and so forth. And then as far as for what special considerations you want to look at when you're structuring these type of deals, a lot of it comes on the equity side, because there is more complexity built in, because you're trying to get the tax benefits for the investors in that piece. And that is that for dividends, you want to make sure that you meet like the holding period requirements, so that basically you can fall into the qualified dividend bucket versus the ordinary dividend. And then for stock redemptions, you also want to go through and you basically want to go and like focus on basically the holding period requirements, or basically, for example, you know, is it not essential to a dividend, and then making sure it's also like more than 12 months, and then kind of going under that category. As far as for the other safe harbor categories, I have those as backup in your pocket, but I really kind of focus on the not essentially equivalent to a dividend category, make sure you satisfy that. And if you do, you can be in good shape from a tax standpoint. And then finally, you got to look at Code Section 1202. It may be beneficial to delay payments and to kind of structure it. You can really kind of get creative. And my bottom line assessment is that you can have like this general rule or framework, but keep it broad enough so that it's not stymieing your creativity, because really for a lot of these deals what it comes down to is you can be really creative and have benefits for both investors and for the entrepreneurs, so that really these deals are conducive for both sides, and it makes both sides want to work together and get what they want. And with that, that's the end of my presentation.
Well, thank you, Buck. Those who have questions, there's a question box on the screen. Go ahead and type those in, and we'll read them out. A few questions have already come in as Buck was presenting the core slides. The first one is under an equity deal, are you setting a valuation for the company, and how do you set it?
As far as for the equity deal itself, that's a great question. Basically, you'd want to kind of go through and look at what the valuation of the company is. For any type of deal on the equity side, you do. There's just not going to be as much scrutiny for the RBF equity deals versus just the typical private placement transaction, because the investor knows what their return is actually going to go and be, whether it's 3x or 5x versus it being uncapped in the traditional type of deal, and so there's not as much emphasis on it. But my recommendation, bottom line, would be have some type of valuation, so at least you have talking points and stuff like that to work through with the investors so they can kind of see where to go and value their shares. It's also good to have it too as well, because if you're thinking about issuing stock options and stuff like that, it's good to be able to have a valuation for your 409A compliance as well.
In the event of an liquidation or M&A exit through an acquisition, do the RBF funders get to participate through their equity, or do they not participate?
That's another good question. Actually, as far as like if there's some type of change of control event or there's a liquidation, typically how I structure it for my clients if they're on the investor side is they basically would have what's known as a put option where they can exercise it, and then they would actually go and participate in that change of control event. And if you word the documents right, they're one of the first ones to get paid going out that gate if there's a change of control. And then for liquidation, you do it similarly as far as for it. Basically, they would need to get paid up to known as their put price. The put price is down to the remaining amount of revenue interest should be paid. For example, if the deal terms worked out, they were supposed to get $2 million and they had like $1 million already, then basically the remaining amount then would be the amount they need to be paid, and the rest of the stock should be paid after them.
In your presentation, you talked about the usury laws. What were the rates again?
I'm sorry, you cut out a little bit, Hall. Could you repeat that question?
In the debt discussion, you talked about the Texas usury laws. What were the cap rates for that?
Oh, great. Yeah, as far as for the cap rates in that, the question is that's where you kind of got to be careful when you're structuring the documents. Really, generally speaking, that if you go back to this slide, hang on one second. Here it is. Right here. Basically, if you go to this link right here, it'll show the rate. Really what it comes down to is this, where you got to be careful on the debt side is that anything below $250,000, your return on the debt side is going to be limited to just 18%. Once you go above $250,000 and provided certain other requirements are met in the Texas Finance Code and stuff, you can then go and fall under what's known as a qualified commercial loan. And for qualified commercial loan, you're then for state are able to go and share in the company revenue stream, and that sharing of the revenue is expressly stated to not go and constitute interest payments, and so therefore you're able to go and get a higher return. And so when you're doing debt deals, a lot of times if investors want a higher return, then you might want to look at basically making sure that you satisfy the requirement known as the qualified loan.
Okay. The next question is the 2012 Tax Repayer Relief Act renews and extends the 100% capital gain exclusion relating to gain realized on, quote, qualified small business stock, quote. Have you used that provision?
You know, I haven't used it for it as far as for the deals. And really the deals that I've basically been working for so far 50%, and that's why I didn't mention it, but available, and that's something you could actually go and explore and look at. Just caution you on is, again, just make sure that you're getting the code requirements, specifications for Section 1202 and the other revenue code regulations so that you don't trip up at a later point.
All right. Are there discussions going on in Congress about changing the dividend laws that might impact the structure you have there?
As far as for that, there have been discussions, but from what I've seen so far, there's nothing been like really concrete movement or anything like right now. I think everyone's still licking their wounds from back in January and stuff. But my concern is that as you continue to have continuous pressure on the government to raise additional revenues, I'm sure they'll come back and revisit it, and that's why it's good to structure the RBF deal so that the payments that are going to come back to the investors, they can under the stock redemption or basically dividends. Because if you look here in the present itself under like the dividend taxation, and you do look at the whole analysis here, for the most part, outside of like when you had like the Bush years where tax rates dropped significantly before that point, most of the dividend rates were actually higher before, and so basically the propensity that the qualified dividend rates may actually go up in the future. But what has not throughout this whole time period is that if you look at the most part, capital gains have stayed around about the 15%, and so that's more of a safe zone. You want to take into account documents are flexible enough. This change rules on you that you're not suddenly having investors be higher tax, and the investors will appreciate that.
Okay. Can these deals be structured with a balloon payment in the final year or any other year?
They can be. Basically, it works, and I didn't go into this detailed presentation, but it's good for everyone to know, is that typically it's up your bank account structure. You're going through like a revenue-based transaction, you really have like 3 different bank accounts. First layer, number 1, the collection accounts where the company gets the credit card, debit card, or a lockbox account, and so forth. Then the second layer where you have like this account, and you have a trustee entity that basically in and holds the money in trust for the investor. And then the third tier account is basically the company concentration account and investor concentration account. Well, the money in the trust account flow from level 1 to level 2 account, the trust, then go out to the company account in a rapid order manner because they need it for their operations. However, the portion of the interest that's being held back from the investors can be held back in the trust account, and if you documents correctly, then basically you can the timing of when the payment occurs so you can have the balloon that the parties work out for the deal transaction.
Okay, can you describe the bank account structures? It sounds like there's several bank accounts. Can you describe them in more detail?
I went through a little bit right now, but accounts would be kind of like this. Level 1, best way to think about it is if you draw like horizontal lines underneath each other. And if you think about it like for right here, I could probably just show you here, like level 1 would be like right like your collection accounts and basically like your lockbox accounts. And that would be where you specify in the deal documents that company ABC or the target company that's coming in to get the investor funds, these are the accounts that you'll use to go and get all the revenue from your customers. So everyone's aware of it. And then what would happen is you would then have like a second layer account, which is basically called what's known as a joint concentration account. That means it's a trust account where a third-party entity is coming in and basically going and facilitating the transaction where, in essence, it takes the money from the level 1 accounts to level 2 accounts, because in your deal documents, you'll have it stipulated that the company won't have the ability to take any money from the level 1 accounts for its operations. The trustee needs to transfer it to what's known as the company concentration account, which would be the level 3 accounts, which would be the account below the joint concentration account. And let's just keep a simple example. Say it's a 90-10 ratio. 90% of the gross revenues go to the company, 10% goes to the investors. Well, 90% of the money in this level 2 account probably would immediately, the same day you transfer it from the settlement accounts, would go to the company account. And depending on the deal documents, you can have that occurring on a daily basis, biweekly, or monthly basis, whatever they're comfortable with. And then the remaining amount of money would then actually go and be held back in this level 2 account until the terms of the RBF deal documents are satisfied, and then it would then go down to the investor account, or the trustee entity would just cut checks to the investors and they get their money that way.
Okay. Are there any other questions that we have out there? We've gone through the ones that have been presented so far. I'll give everybody just one last chance to put their questions in. As I said before, we will send out the recording and the slides here later today. I don't see any more questions coming in for now. Thank you so much, Buck, for spending your time and putting this together. It's quite a bit of good information, and appreciate your putting that for the group together. I want to thank you guys in the audience for coming and joining us today. We'll be having more webinars on these topics in the future, and look forward to your feedback on what topics would be of interest to you. So I'll be coming back around asking more questions about that. If you do have any questions, feel free to reach out to me directly or to Buck Hollister directly, who has his contact details there on the screen. We'll go ahead and close it out here at this point, and everyone have a good weekend, and we'll go from there. Thanks so much. Thank you, Buck.
Thank you, everyone.